Hey everybody, welcome back to another Steady Wealth podcast. We try to do best job possible to, bring to you different types of investment ideas through the lens of education, making sure that we're aware of opportunities that may not be that much talked about in, let's say, financial media. And I have the great pleasure today to have with me another gentleman from Crane Shares. Luke Oliver is the head of strategy. Luke, how are you?
Good, thank you. Thanks for having me on.
It's great to have you here. And we were just talking a little bit off camera about, this whole sort of kind of a hot debate when it comes to ESG or sort of the green energy movement. And some people don't get the warm and fuzzies on that. Some people do, right? But at the end of the day, what we're about here, what this podcast is about, what I'm in the business for our clients, and you too, quite frankly, is to make money and look for opportunities. That's away from other reasons to maybe invest. Although of course there is other reasons to potentially invest in something like this. But if you could kind of give us a 30,000 foot view of some of this stuff, and then we'll dig in. And I have to say, there are so many cool opportunities out there, but this is one of the ones that gets me most excited because I think it's very idiosyncratic and kind of, from a correlation perspective, not a lot of correlation to, let's say, your Max 7 stocks, which at any given point may have volatility that we don't want to deal with.
Yeah, and as you said, what investors need are diversifiers with strong upside potential, and that's what everyone. I think the big misstep around this whole ESG thing is people forgot what our jobs were. Our jobs are to be investors, manage other people's wealth, manage assets, and create returns, create diversified return streams. So that's what our job is. And then if we can lean that towards something that is impactful, then I think that's fantastic as an added benefit using capital to have positive impact. But if you lose sight of trying to create returns, then you're not really going to get the real capital flows, and then you're not going to have any impact. So you have to start with the investment, and that's what we do at Crane Shares. That's what what we call our climate suite of products is all about. And sometimes the word climate jumps out at people, and they say, "Oh, I'm not. That's that. Those guys do climate and ESG, and we don't do that." That's not. I don't have to have that conversation with people because, as you'll see, all of these are true investments, and so none of these investments rely on doing good or commitments to reducing emissions or anything like that. This is all about economics. And so what I really focus on is the fact that we know that actually there is a massive concentration of carbon dioxide in the atmosphere, and that is causing shifts in global temperatures. I mean, we have a nice chart in one of our decks that shows this sort of exponential increase, and it's only by a couple of degrees. So it's not the difference between a hot day and a cold day. We're just talking about, on average, these slightly high temperatures are making certain things like crop cycles and ecosystems begin to collapse. And what that does is going to create this isn't about saving biodiversity, which a lot of people jump on it. I mean, of course it is, but this is going to cause massive geopolitical unrest, and that is what nobody wants and no government wants. And that's why this goes beyond just the climate and the environment. It's geopolitics, it's energy security, and the fact that we keep exponentially using more energy. I mean, AI is massively increasing the amount of energy required. We need more energy, and what renewable energy is actually just infinite energy. Fossil fuels, there's a finite amount of it. It's expensive. If we can scale renewable energy, we'll bring down costs. So there is going to be this massive wave of capital. McKinsey puts it at 150 trillion. I mean, obscene number that has to move hands between now and 2050 to do this. And so we want to be invested where that capital is going, and we want to make the returns of
That's fascinating. And the amount of institutional money in this. I mean, just quickly rewind for a second to give people a little bit of perspective. And we've got a whole bunch of great charts that you were kind enough to share with us. I'm going to get to those in just a second. But the ESG movement, again, some people like it, some people don't. There's been a lot of at investment houses, private banks, et cetera, a lot of, let's create a fund, put an ESG sticker on it, and someone will buy it because they have to, kind of thing. What we're saying here, just to kind of summarize what we said in the first couple of minutes here, is there is a huge opportunity here. It's not about yes, it's nice to save the planet. I think we all want that, but that's not really the reason to buy it. It's because there is a huge demand for these kind of things. So I'm going to quickly share my screen, Luke, and I'll let you roll with this
Yeah.
and tell me where you want to go. But the first thing I want to show people here is a slide that you shared with me, and I'm going to make this full screen, which make it a bit larger, which really kind of highlights you guys as ETFs. And I should say, also for disclosure purposes, no one's getting paid here. I simply just invited Luke, and he was kind enough to accept to talk about the opportunity here. But please, Luke, take it away and let us know. We've talked about KRBN, the carbon ETF,
Yeah.
for years. I love it. I'm personally invested in full disclosure. I might add to it at some point in the not too distant future. So anyway, here we are.
Yeah. So, I talked a little bit about the problem. Government policy, government spending in every major economy has already shifted to catalyzing the innovation and scaling of domestic renewable energy. This is a massive tidal shift that our economies are going through, and you should be investing alongside that. So, as you said, put aside investing because you're hoping for some non-investment outcome. That's great. It's noble, but why don't you invest in real opportunities that are going to drive great returns, be diversifiers to your portfolio when you have volatility in the equity markets, and are going to drive that decarbonization. And so when you think about what that means, at CraneShares, we developed these three pillars of investments that you need to think about. The first one is the carbon market, and that's what I'm going to probably talk about most. But just quickly summarizing it, the compliance carbon market. I'm not talking about forestry projects or people building direct air capture machines. I'm talking about the government policy. This is $1 trillion market. This is Europe, the state of California, all of the northeastern states in the US, the UK, which are the four majors that we track, but also there's China, there's Japan, there's Korea, there's New Zealand, there's Australia. There's 70 of these programs globally where they put a price on carbon and they have a tradable asset that represents each ton, and it's basically like a permit to buy carbon. And they are designing this market price of carbon to rise dramatically over the next 6 to 10 years in order to accelerate spending and innovation in decarbonization. So you can actually be long that credit. So many people think, which companies are going to do best? I should buy those companies that are going to benefit from this price of carbon rising. Get long carbon, be purely in that market, and then you have a diversifier. You're not getting beta to the equity market. So very important. Secondly, there are some equities that you should think about, but it's not necessarily those ESG equities, not the companies that are clean and green today. Maybe you want to invest in companies that are part of solving the problems. So think about, we have you can see on the right side of the slide there, you see our three carbon ETFs that we'll talk about next. We have an ocean engagement fund where we're really, the ocean is another economy. It's something like the 6th or 7th biggest economy in the world. If every country's contribution that comes from the ocean were one economy, it'd be one of the biggest economies in the world. It's one of the least tapped economies in the world. And so that's another market. We also think about the green tech. We also think about EVs, mobility, battery storage that we can get in our ETF, K cars with a K. And then thirdly, every single company that's going to be successful, or every single government that's going to be successful in this transition, is going to need to completely rewire their grids, and it's going to need a lot more battery storage, whether that's in vehicles or homes, or more centrally where we can store renewable energy overnight. So solar, when it's not sunny, we need to store that power. So there is going to be, so instead of trying to pick companies and economies that are going to succeed, what will go up in value when everybody exponentially demands it are those metals. So we have a metals fund that holds copper, which is the key to the whole grid, and then cobalt and lithium, and zinc and aluminum and nickel that you're going to need for those batteries and solar panels and windmills and everything else that is going into this transition. So these are the three places: carbon, transition equities, and transition resources. And these are the three things that investors need, and that's why we built this lineup of product. And I should mention, that we plan to add some fixed income to this space as well. So watch this space.
Interesting. I mean, actually fascinating, really, quite frankly, is the best way of putting it. I was wondering if you might be able to just go a little bit into, I don't want to get too sort of geeky on it, but I've been talking to this carbon story, like I said before, for several years. If you could talk a little bit about, so people can get their head around like the understanding of how these carbon credits work, because that's kind of, really what we're how it's investing. I know there's obviously the theme here, carbon. It's like basically, and I'm sure you can do a better job at explaining it than I do, but basically companies have to buy these carbon credits so they can emit certain amount of
Yes.
carbon, right? So
Yeah.
I'm sure you've got a more elegant way of explaining that than I
Yeah.
do.
Yeah. Well, so and there's a slide coming up. If you click forward a couple of slides, I've got
Yeah.
got a nice image. Hopefully that's useful. Um,
Is it
but
7? This one here.
this one is good. Yeah. So
Yep.
so is it? But as you
Perfect.
said, there's two carbon markets. There's the compliance carbon market, which is the government-run official carbon price of that economy, where it's completely fungible carbon allowances, government issued, fully transparent, backed by policy, and the buyers must buy them by law under stiff penalty. A bit like paying taxes. If you're polluting in Europe, you absolutely, but not because you're a nice company, not because you've made commitments to the environment, because by law you must buy these credits. Same in the state of California, same as in UK. So you have this market that is completely robust, both on the supply and demand side. There's also the voluntary carbon market, which gets all the headlines, which is people talking about forestry projects and saving forests, growing forests. This is a very interesting market. Will be a very important market for solving climate issues in the future, beginning right now. But it's not a robust market because every project is different. There are thousands of different projects. Every project is there's no standardization or centralized regulation around it, and no one needs to buy these things. Companies just commit to buy them. So we put the voluntary to one side. It's a $2 billion a year market, but we put that to the side. The compliance market, which we think is incredibly interesting for all portfolios and is robust asset class today, is compliance. This is where the government programs run them. And this is a $1 trillion market. This is not a $2 billion sounded big at first, right? But $1 trillion market in compliance carbon. So this is a real asset class. And so this is kind of how it works. This diagram kind of illustrates it. Let's just use the state of California as an example. California measures the pollution coming out of the industries in California. And that forms a cap. These are called cap and trade programs. That's actually how they solved acid rain. They put a cap and trade program in place, solved acid rain. That was a small problem. Methane, CO2, big problem. So this is what we're working on now. So they set a cap and they auction every year. So the cap in California is about 300 million tons of carbon is released by the state of California every year. So they sell that many credits each year at auction. All the companies have to bid and make sure they can get enough of these credits for them to operate their business. Yep. No one's saying the company's not allowed to do things. No one's saying the company has to reduce its output. Companies can do what they like as long as they source enough credits to do it. And they originally auctioned way more than are needed, so those companies can build hedges. No one wants to damage the economy. The point of this is to create an economic incentive for companies to decarbonize, but also allow them to manage that themselves and even monetize the opportunity by being a leader. If you lead and invest more in decarbonization, you won't need as many credits, and so you'll be more competitive than your peers, and you'll also be able to sell some of those credits. And people often talk about Elon Musk is one of the reasons Tesla was profitable in the early years was they didn't need as many credits as the other car makers. Slightly different program, but you get the idea that they can sell these credits they don't need for a profit, and it creates this new factor within the economy that speeds innovation without damaging standards of livings or the amount of power that's generated or products produced. So what they do is, if their aim is to reduce emissions by 40%, they take this cap and they taper it. That's the top dark line. They reduce the amount they auction every year down to 2030 and to 2040 and to 2050 by however much they want to reduce emissions. And so what that does on the inverse is create upward pressure. You reduce the supply and then you force companies to figure out ways to decarbonize. So if we just click, I hope you don't, I'm not usually a slide guy, but I feel like I'm on a roll with the slides here. If we could just go to the next one. And then these are all, there's a few pictures of the companies there. So what this does is create an auction revenue for the government, which they use to decarbonize the public markets. They spend on things like if you're getting a waiver to buy an EV in California, guess where that money comes from? It's coming from the revenues here.
Yeah.
So you're creating incentives for people to decarbonize. Secondly, you get this fuel switching. Most companies are just economists and capitalists like we are. They are looking for the cheapest fuel, so they're burning coal oftentimes. Now you're putting a price on carbon. Coal doesn't seem so expensive because you have to buy extra credits to burn coal. So you start shifting to greener fuels. The next greenest thing is natural gas. Natural gas, half the pollution of coal, but it's still a fossil fuel, still emits CO2. And so we shift people to natural gas, and eventually we shift them fully to renewable. At the same time, on the third panel, this price is suddenly making any innovation in carbon capture or carbon reduction very valuable. It was never a valuable invention 30 years ago. It would have been interesting, but no one cared. That's why no one ever developed them.
Yeah.
Now there's money to be made. We're seeing this arms race, and that arms race is going to reduce the cost, both competition.
So Luke, is it just so for people to understand? Would it be safe to say that really what this is we talk about getting long carbon? You're really getting long these, the price of carbon credits.
You're getting long, You're getting long the tightening policy globally
Exactly.
On carbon.
Fascinating. Now, I'll try to draw another analogy here, which is a little bit like you could, and this might be a stretch, and I'm not trying to take another asset classes here, but just some people like the Bitcoin idea because it's got a limited supply, right? It's say 21-ish million. You could kind of make a somewhat, and I might be drawing, not very direct lines here, but there is in this case, a declining supply, like not just finite, it's literally going down of carbon credits. So, and then that money, that fund, if you will, that gets built up, gets reinvested into things. If you buy a Tesla or something like that, or
so it's an interesting analogy. So yes, what drives the prices higher is the tightening policy to tighten the number of credits, continually shrinking. Where the analogy ends with cryptocurrency is that these are completely regulated by the government. The supply is completely transparent. Every single unit is identical. So that's fair for Bitcoin too, I guess. And there is an intrinsic value. So with crypto, you're saying, well, this should go up because the supply is going down. But no one needs a Bitcoin right now, right? No, there's no intrinsic value. We're trying to say to people, I promise it's worth something because it's a store of value, right? It's the new gold. With a carbon credit, there's a true intrinsic value, which is to every company in that economy, they need to buy these. So whatever their profit margin is budget for buying these carbon credits. So every company will tell you that they've worked out that carbon credits should be $92. And if they're trading less than that, we're buying them. If they're trading more than that, maybe we're selling them. And every company knows an intrinsic value. So it has a return profile potential like that, but yet so much more robust with the intrinsic value, which you can't put on a crypto today. So it's important.
And I wasn't trying to go beyond just the limited supply analogy here. I'm just trying to find points sometimes how to get people to kind of think about something. Another question that comes up here. So this is, just to kind of summarize what we're at right now on the conversation. Again, this is not about I have a green thumb and I want to protect the planet. I think we all want, I think we all want that. No one's like, oh, I want to pollute on purpose. But there's a difference here because there's actually real investment opportunity. That's the point, diversification, all that kind of stuff. I would argue, and I'd love to hear you comment on this in a minute, the correlation potential of something like this versus, let's say the momentum trade, right? I would argue there's probably very little correlation there. But just quickly, I'm curious before we get to that point, what about margins? So let's say you're company XYZ and you're buying X number of carbon credits. What is it doing? How badly is the margin compression there? Is it noticeable much or?
No. So I mean these carbon prices. So maybe this is where we get into the forecast. California is trading between $30 and $40 a ton of carbon. The state of California itself is forecasting that it will be moving its price to about $140 by 2030. That's like a 24% annualized return between now and 2030. Europe is trading about 75 euros So did I say dollars? For California, it's obviously dollars. For Europe, it's euros. So 70
Sure.
euros a ton. And the forecasts are about $150 euros a ton by 2030. So that's somewhere around 15+% annualized return. So really incredible returns. And because the price is still not really materially making companies reconsider. We're still in the zone in California where companies are saying, oh, we just buy these things now. As soon as that price starts to rise, and even that momentum of the price rising is going to have those California companies saying, we should be buying more of these because they're rising and we need to hedge our exposure to it. And that's when the price discovery happens. And these are market mechanisms. They want us and you to invest because you are part of the price discovery. They want to create an opportunity for the market to seek this price. And I'd love to show people this. I think it's page 16 in our deck because the California market is especially interesting because it has this structured design. They have a floor price and they have a ceiling price and they have a couple of liquidity tiers along the way. So today we're trading below $40 a ton. By 2030, the floor price, all of these price tiers increase by CPI, so by inflation, plus 5%. So your sort of base assumption here is CPI plus 5, which is a great return. And yet the upside from, so you can see the zigzag blue line here that is at the bottom of that little triangle. We're trading around $37 a ton. The floor price is going to rise to meet us at $40 by 2030. And the ceiling is going to be almost $140. And that's where I get this very asymmetric trade where our downside becomes less and less and our upside becomes higher and higher. And that's why we expect these very high, if I take California's $134 by 2030 versus today's price, like I say, it's like a 24% annualized return. So it's a really incredible return that we are being invited to participate in. And some people say, well, that sounds like a free lunch, and there's no such thing as a free lunch. But it's not a free lunch. It's a volatile asset. It moves a lot inside this range. So as long as you can stomach that volatility, you will get these. You should potentially get these great returns. But you asked me the question about correlation. That's the key. Correlation is so low to US equities. It's about 0.3, meaning that when stocks go up, these both stocks and credits should be rising, but they're not moving on the same factors. And so when equities are down, your carbon can be up. And that's, oversimplifying it, but correlation is incredibly low. So it's a really great addition to a portfolio.
I love it.
I'd love to just say one thing. This investor I spoke to yesterday called this, for him, the Rip Van Winkle trade. He's going to do the trade and he's going to wake up in 2030 and see the return. And he's not going to worry that it's up 10% here, down 10% there. This is structured to get there, but it might be a bumpy road.
No, that makes a lot of sense. And it really, like I said at the beginning of the conversation, I try to bring people ideas through the lens of education here that they can consider outside of, the few stocks that everyone talks about all day. There's nothing wrong with them per se, but, I think the diversification aspect here. Another point, you bring up something interesting here. A lot of people are looking for income, be that a fund, a family office, or an individual person, that do-it-yourselfer at home, which of course you have to take inflation into account. You talk about inflation plus 500 basis points, right? 5%. You talk about an inflation protection. Now, obviously, this is not inflation protection month over month because, as you say, there's volatility.
Correct.
And by the way, NVIDIA will have volatility. It'll drop 30% one day, not in one day, but over time. That's normal volatility. This is volatile too. But you think about inflation protection, it's a hell of a story. And by the way, this is government mandated, if you will, right?
Yep. This is you are being offered by these governments the opportunity to participate in this asset that they are structuring to rise much more than it can fall, and there'll be some vol, and that's okay. And I think that's exactly right. And having an explicit CPI plus 5, it's unheard of. I think that even when this market, by 2035 is hitting its ceiling, it's still going up CPI plus 5, and I think it will be just as attractive just only doing CPI plus 5 would remain very attractive. So explicit or implicit inflation protection plus 5% is very unique.
Yeah, no, it really is, and I'm trying to work on a little example here that I'd love to share when I get it done. Talk to us a little bit about, if you don't mind, Luke, uh, about how much of a mandate it is. Like, if you're a company at all, let's say in California or in Europe, like every single company has to do this. I mean, ones that like a financial company doesn't, right? But
Yeah. Well, anyone that is polluting above a certain minimum threshold,
yeah,
which is 25,000 tons, I think. So
okay,
it does. You end up with most manufacturers, most agriculture,
yeah,
steel, glass, cement, huge polluters. We're seeing maritime, so shipping, being added to these programs. Aviation is not in the programs yet, but will be added.
oh
And so
wow,
more and more of the big polluting industries will be added. So we're seeing these programs cover more and more geography and more industries within that geography. So, for
yeah,
instance, in the northeast of the US, from Virginia up to Maine, it's farming isn't covered, manufacturing isn't covered. It's just power generation. So it's all power stations. But it's all, if you think about the biggest companies involved in, say, California, it's Chevron and Marathon and all these kind of guys.
yeah,
And the other thing that's also interesting is that these companies are taking it very seriously. So in the same way, we all know that every oil company also has a oil trading desk and a power trading desk and a gas trading desk. They all have carbon desks trading carbon. This is not niche. This carbon market. Someone told me the other day it's bigger than the gold market. So this is
amazing.
not something for people to think. Oh, I watched a podcast. This guy was talking about this thing. It sounded interesting, but it sounds too on the periphery.
Right.
All the big family offices, all the big institutions, all the big corporations are in this market, and investors like the investors that follow you should be thinking about this too. This is something that is an institutional investment, and by wrapping in an ETF like KRBN or KCCA, we've made it available to everybody.
Well, I love it, and I want to wrap up on those two ETFs, but I crafted this little chart to give people a little bit of perspective. So we took the SPY, that's your trusty S&P 500 chart chaser ETF, and I overlaid it in blue with KRBN. That's one of the ETFs that Luke and his team manage. The KRBN. Looking at a 5-year look back here, you can see KRBN is outperforming the SPY with again a lot more sort of inflation protection, if you will, embedded through all the stuff we just talked about.
Mm-hmm.
Diversification, lack of correlation, again 0.3 correlation. It really is an interesting thing to think
Yep.
about.
And just to add to that,
Mm-hmm.
the S&P and the stock market and any company can become overvalued, right? Because it goes up too much, that valuation becomes too stretched.
Yeah.
With carbon, the policy keeps tightening that supply, so it actually doesn't get overvalued. It can get rich to its current supply, but they're constantly ratcheting down the supply and
Yeah.
making those units more valuable. So it doesn't get overstretched or mean revert in the same way that stocks might. So it's just another factor.
No, it's great. It's a great point. Maybe just so we do see all sides, what's the risk? Because I remember
Yeah.
talking to one of my buddies. He used to run HFR, the hedge fund indices firm, and we were talking about what's the risk on this? Literally, specifically uh, KRBN
Yes.
and the whole credits. And very quickly the conversation turned to what there's always the politics, meaning you could have a new you know a new party come in or whatever, and they say, the hell with it, right? Where do you see the risk on
Yeah.
that?
So you're right. That's the main risk factor, which is different to many other markets, which kind of adds to that diversification benefits or low correlations. So that is the risk is, and to say it another way is, what if they change? What if the policy making changes in a way that's less tightening, more easing, less stringent on those targets? So I don't think there's any risk of like catastrophic unwinding of let's cancel these programs. I mean, these programs have survived through numerous tests, numerous administrations, in the US and Europe, more left leaning, more right leaning. because of the fact that there's the economic incentives
Mm-hmm.
built into this,
Yeah.
it's actually, I mean, a lot of people think this is, okay, so in the US, if we're moving right from, the next administration might be further right than the current one, is this a threat to this market? This is a center right policy. California program was a Republican program. This is a market solution. This is capitalism, and so I don't see anything to fear from material, big shifts in on the political front, especially in the US. If we get this isn't a federal program; these are state-run programs, and they're deeply embedded within the states that run them. So you end up having these robust markets within robust states. Go to Europe. We've seen actually this shift actually has gone a little more left than people thought.
Yep.
And in the UK, I don't think it was really a left-right thing, but it was a change thing. But we've gone towards, Labour, who might be more open to bringing the UK closer to Europe. So all of these things are generally positive. And so as I said, I don't think there's any risk of catastrophe in that sense. But there is risks that, we have economic slowdown, and people say, should we ease the market a little? And generally, you'll see we've got pricing models and demand-supply models. But generally, that we might see that they pause tightening, things like that will create volatility. I don't think it changes the long-term thesis of where these prices get to by 2030, 2040, and so on. And then just to add another thing that we think about in terms of risk is, what if these programs are working so well that emissions companies start decarbonizing, like cement, they start making cement without pollution? Then we might have volatility in this market, because people say, well, we're not sure what the demand is going to be if they're fixing things. But that's okay, because that's the impact we're hoping for. And then the governments that run this, the European Commission, will then tighten the program. If they see industries decarbonizing faster than the model, they'll just accelerate the tightening.
Yeah.
It's so it's a little bit, think about Jerome Powell at the Fed. If we have inflation, people say, oh, they're going to increase rates. If we have less inflation, less inflation, we might ease on rates. And so these programs will always adjust and adapt. And so I don't think innovation is actually a risk, but it's a risk factor that we talk about with clients sometimes.
Fantastic. Luke, this is great stuff. One last point, just to quickly add on what you mentioned. If we talk about the political risk, right, or the change of administration risk, one other way of thinking about it is we do have, a lot of debt, not just here in the United States, but also in Europe. So this is not, a country-specific thing necessarily. I would imagine that anything that can get us more tax money without making it that obvious, without raising taxes to, on sort of a newspaper headline level, would probably be something that people would consider. So, from that perspective too, maybe a bit of a hedge to that.
I think that's absolutely a hedge. To politicians that don't like taxes, they still like tax revenue. And like you said, this is a way to generate revenue while decarbonizing the economy. It's actually a stimulus. I mean, that money turns around and is a stimulus for those politicians as well.
Yeah,
so
again, it's a I hate to use the word sneaky, and I don't mean that in a bad way, but it's a less headline grabbing, sort of, pitchfork kind of reaction. Luke, this has been fantastic. I'm going to quickly bring up the website so people are aware where they can find out more about it. Again, no one's getting paid here. This is literally I just happen to really like the story. Craneshares.com. We also did an interview with your colleague Brendan on KWeb a little while ago. That was very well received. Very much enjoyed that. Got a lot of great feedback, and I'm sure we're going to get a lot of great feedback on this one as well. Luke, great pleasure. Hope to have you back another time.
Yeah. Me and Brendan are always around, and as you can see, there's three core areas for our firm, and we love talking about it. So thanks so much.
Love it. Thank you, Luke.